Hello everyone, welcome back to the Everforward Mindset YouTube channel. I'm your host, Michael Rebello. I'm the host of the Everforward Mindset podcast, and I'm the owner of Everforward Capital Partners. Great to have you with us today, and really excited to talk about today's topic, which is what is multifamily real estate. So for those of you that follow me on my social media platforms, or those of you that follow my content from months before up until now, I'm a multifamily real estate entrepreneur, investor, and operator. So a lot of people have asked me, what is multifamily real estate? How do you get in? What's the good and bad? Basically, what's the story of this investment opportunity? So we're going to dive into that today. So what is multifamily real estate? So I have a little bit of a thing here. Building wealth through cash flow, appreciation, and smart investments. So this is basically a very dumbed down summary of what is multifamily real estate, especially on the investment side. So we have cash flow, which is the cash flow that's flowing in, like, how much cash flow are you getting, or how much cash you're getting in monthly, or depending on how it's structured through distribution. So basically how much you're collecting for rent, maybe fees or premiums, the what's and then, just the finer details. And then you have appreciation. So you have two types of appreciation. You have natural and you have forced appreciation. Natural will always just come on its own, naturally, no pun intended, but you also have forced appreciation. So let's talk about just regular appreciation or natural. So that's like, over time, things just go up in value, like for example, inflation, so the price gets inflated. So let's say in 2010, you bought a property for $5 million. And then let's say 15 years later, so 2025, it would probably be worth 8 to 10 million, depending on where it is, depending on the market stability. So that's natural appreciation. Forced appreciation is where you add on to that natural appreciation and you force it upward. So let's say that same $5 million property or asset is something called a value add. So it's a little dilapidated, needs some paint, needs some new furnishings, maybe some new cabinetry, you need some new appliances, just to bring the property up to modern day market standard. So let's say the property is built in 1994 and you want to bring it up to 2025 standards. That's called value add. You're adding value to the property, bringing it up to market standard. So you purchased it for $5 million as a value add property in let's say you bought in 2010, like I said previously, and then 2025, that value could be 10 million, 8 million, or maybe more. But once you add that value, once you bring it up to market standard, it could very well be 20 million. It could be much, much more than you could ever think of. So there's your natural and forced appreciation. And only that, smart investments. So you want to invest in something that makes sense and aligns with what you want, like your investment goals. What do you want? Do you want to retire early? Do you want steady income, cash flow? Do you want to invest passively? Do you want tax advantages? Do you want to get on the operational side, or do you want to become on the passive side, which is limited partner, which is your investors, and then you have general partners, which is like the more operators. So do you want to be more hands-on or more hands-off? So look at your goals, look at the numbers, and look where you are for risk tolerance, all these little finer details to make sure you invest intelligently. Next, we have multifamily real estate refers to properties with multiple housing units under one roof, which is pretty much the quick and dirty definition of multifamily. So you'll have your single family, which is exactly what it sounds like. Maybe you have a husband and wife and a couple of kids under one roof. Like for example, this house. This house is it has 4 bedrooms, it has a bathroom, it has a living room, and that's it. It's just one living quarter. But with under one roof, you could have, like, let's say 1 bedroom or studio as like 1, 2, 3, 4. So 4 multiple housing units. Let's say if you want to convert this house into one, and you could create a quadplex. So it's basically 4 houses in one. So that's the beauty of it. So instead of, having a single family, which is, you're only tenant and your only cash flow coming in, if you lose that person, then your cash flow in your business just grinds to a halt. But if you have multiple under the same roof, if you lose a tenant, you still have others that are still paying the rent. But hopefully you get the point on that. But anyway, so basically once you see like all these apartment complexes, these high rises, it's basically all these little homes under one roof, pretty much. Next, we have, it includes duplexes, triplexes, fourplexes, and large apartment buildings. So really quick on the rundown here. So this bullet point right here, I want you to understand something really quick. Your duplex or single family, duplex, triplex, and fourplexes, those are considered residential properties because they're under 5 units. When you go 5 units more, or 5 units more, that is considered commercial. So anything 5 and up is considered commercial, but it's residential, commercial, multifamily real estate. I guess if we want to be really, really technical, but larger apartments will be 5 plus. So your 5, 10, 15, 20, and so on. Those are considered commercial multifamilies. So it includes all that. And lastly, investors buy these properties to generate rental income and long-term appreciation. I want you to understand something very quickly before I go deep into this presentation. It's long-term. This is not a get-rich-quick scheme. I can promise you that you're not going to get rich right off the bat with one single property. It just doesn't work that way. And before we go into this, I'm not any financial or legal counsel. I am not any investment counsel. I just want to put this legal disclaimer out there. Make sure you do your due diligence, make sure you do your homework, and make sure you invest smartly, understand risk management, understand how the business works, and just basically study the business before you get in so you can protect yourself and protect your assets and your equity and capital. So please do make note of that. But let's go back to this for a second. Rental income, long-term appreciation. So appreciation does not happen overnight. I'll give you a quick rundown, but actually I'm just going to move to the second slide just for a minute because we're pretty much done with that one. When you look at the long-term effects of this, you're holding a property. We usually like to hold properties for 3 to 7 years, depending on the property and the business plan. It usually takes 1 year to 2 years, maybe even 3, to stabilize the property, to bring it up to where we can have like a fresh slate. So basically, when we purchase a property, you have that big chalkboard that already has somebody's work on that, but you don't need it anymore. You have to go in and clean it. You have to take care of everything. And then once you have your fresh slate, that's stabilized. And then you can start, going on the drawing board, starting to do your calculations, whatever, drawings, whatever. And that will be your value add or your business plan that you're implementing on the property, which will be your chalkboard. So it takes a while. It takes a lot of effort. It takes a lot of teamwork. It takes a lot of energy. It takes a lot of phone calls. So this is definitely a long-term game. But within 5, 10, 15 years, you will be comfortable when you do your homework, you do the due diligence right, you partner up with the right people, you understand the business and numbers, and that you have invested smartly. So it can happen. You can get out and you can retire earlier. You can be a passive investor quickly. Like you can invest pretty much today and you can start getting into real estate. It's not for the ultra rich. It's not for, the higher white collar people. No. You can actually get in today. As long as you partner up with people, you understand. Basically, just do your homework. Study, do your homework, understand the business so you know what you're getting into and where you can fit in. But anyway, it's long-term. It's definitely long-term, not a get-rich-quick scheme, I will tell you that. But anyways, enough of that. Let's move on to the next slide. How it can benefit you. So how can multifamily real estate benefit you? So you have multiple income streams. Rent from multiple tenants reduces risk. Just like I said about the single family, when you have a single family, which is basically your one tenant, if you lose that one tenant, you lose your rent and your income stream. So that's a no-no. I know people have excelled in the single family aspect of real estate. That's their niche, but my niche is something more because I want that less risk of, losing all of my income. So instead of me having one tenant, maybe I can have 10, 15, 20 tenants. So if I do lose one or two, I still have income coming in. That's why we like to purchase larger properties, because one, they can be stabilized more. Banks like the larger properties as well. Lenders like these properties as well, the bigger properties too. And managing a 5-unit apartment complex is just as hard as managing 100 units. So the cash flow and the rental income will change from the size of the apartment. So let's say it's 10. If you have 10 tenants and one of them leaves, you have 9 out of 10 of your income stream, right? But once you go to 50, if you have one leave, you have 49 out of 50 paying. So that's a huge difference. When you look at the numbers on the financial aspect, it really makes sense on why you want to go for the bigger properties, not the smaller ones. I myself want to go for the smaller ones because if I can purchase, two 30-unit properties instead of one 60-unit, it's just basically business plan and so on and so forth. I won't get into the nitty-gritty details because I want to stay on topic. But anyways, to summarize this, multiple income streams for multiple tenants equals multiple rental income. So it's great. Next, you have wealth building, appreciation and equity growth over time. So equity growth is the cash flow that's coming in, the cash flow that you can cash in today, use it to reinvest. You could use it to maybe invest in commodities if you want to use it as investment money. But, check with, tax rules, tax legal stuff, so you don't get hit with capital gains tax. That's where a CPA comes in handy, or an accountant comes in handy, or an attorney. So that really comes in handy, but I won't get into that. So this wealth building, it definitely can help build your wealth if you invest smartly, and especially with the right people. And not only that, with appreciation, that's where I talked about with that forced and the natural appreciation. So it really is a beautiful thing. It's really cool. Next, you have cash flow, which is the monthly rental income, which covers expenses and builds profits. So really cool thing for you. You have debt that's on the property because the bank is probably financing 50%, 40% of that. I don't know the numbers exactly off the top of my head, but I'm pretty sure it's 50% and up that they finance or lend us money to cover the purchase of the property. Then we have investors and operators that come in to invest in the property and throw some equity in there to cover the cost of purchasing the property, or maybe some value add costs, which is known as capital gains, not capital gains, capital expenditures. So anyways, back to this. So the income will cover your sewage, your water, your electricity, any expenses that you have, contracts, mortgage payments that you have to pay on the building itself. So it's really cool. So you have your income versus your expenses, which once you do the math, that equals your NOI, which is your net operating income. So it's a really important key metric when you're doing the financial due diligence on the property. So this is really great. Cash flow is a beautiful thing. Lastly, we have scalability. It's easier to grow a portfolio than with single family homes. So instead of, having single families, like, if you have 10 single family properties, which basically could be a house, you have 10 units across the board on your portfolio or your track record. That's great. You could be experienced in that niche, but you could pool all those efforts into maybe purchasing a 30, 40, or 50 unit building, which is way more. You can scale your portfolio, you can scale your wealth, you can scale pretty much your business and personal life when you go in and work with these properties and work with people that are tackling these properties. So it's a really, really, really cool thing. So let's talk about the different types. I went over this a little bit earlier, but your small multifamily, which is basically your residential, will be 2 to 4 units. Don't get me wrong, it's definitely easier financing and great for beginners just to get started with. But if you want something more stable and if you want to go with people that are more experienced, I would go with the 5+. But if you really just want to do it on your own with maybe a couple of friends or a couple of partners, you could do 2 to 4 units just to get into the real estate investment side of the business. So it's a good start for you. Next, you have your mid-size, which is 5 to 50 units. Now we're moving into the commercial multifamily real estate because now it's 5 units up, which is more cash flow and professional management. A lot of these property management companies and asset management companies will usually go for these bigger units and these bigger buildings because one, they're just as hard to manage as a 2 to 4 unit. And not only that, it's more income, you can manage things more, and you can work with business partners and execute the business plan to bring the property up and to get profits, make your investors happy, your tenants happy, make everybody happy. So you can get professional management so you don't need to be on site collecting rent, making sure trash has been collected, making sure everyone's not making noise, basically the dirty work. But anyway, then you're going to your large multifamilies, which is 50 and up. This is where we like to aim for. This is where we definitely want to start purchasing properties because this is where you have your institutional investments and economies of scale. So these types of properties, I mean, this one too, but this is more closer to the 50 units aspect. Once you go 50 and up, it can help with inflation, can help with taxes. Banks are more favorable to finance these kind of properties just because income and stability as well. So, I mean, you can do your research on that. You can look at articles on that as well. But this is really great. So when you have your economies of scale, you can hedge against inflation. You can scale as well. There's so much more to this, but I won't bore you with the details. We'll go into that later down the line in a couple of videos. In fact, the next video is going to be this part 2 of that, but it's going to be a different topic. But anyway, so here's a quick analysis of looking for markets, looking for properties, and looking for potential deals. So the first thing is location matters. That's the beauty of it. It's just location, location, location. I mean, there's nothing else to it. So if you're in a booming market where rental demand is going up and the prices are good, everything looks good, there's more investments or more investment activity going in that market, it could be a hot market. But check the statistics of population growth, job market, and demand. Your demand right here is going to be, what is your demand of rental units? If your demand is low, that might not be that may be a sign to not invest in that market right now. Every market is going to have its golden stage where you better get in when it does. So, excuse me. When you're looking at demand, you want to make sure that demand is above supply. So what's the difference between demand and supply? Demand is what is the need for these rental units? Like what is the need for apartments? And supply is how many are actually available. So you don't want supply to outpace demand. You kind of want them to be basically in the same plane almost. You have a lot of markets that have oversupply, and you have a lot of properties that are decreasing the rent to be more favorable for tenants so they can stay longer, and not only that, for more people to come in, because these properties just can't keep up with the amount of oversupply. Like for example, the Sunbelt states, they have a lot of oversupply. So look for those metrics here, but it's definitely population growth, job market, and the demand for rental units. These are pretty much 3 big key metrics. There's more to those, or there's more to these key metrics, but this is basically just a quick analysis. Next, you have your NOI, which is your net operating income, like I said before, which is your income versus your expenses. So you want to make sure that you don't have too much expenses. Like you don't want to have any unnecessary expenses. That's why we look at the financials before we purchase a property. Where can we, get a new contract on basically a service that we have at a cheaper cost but same service? What's the electricity look like? What does the water look like? Do we have water efficiency? Do we have electrical efficient appliances? So look at the expenses. Look where you can decrease the expenses and where you can increase the income. Because when you decrease the expenses, your income's already going up. But if you can also increase that income already with, maybe raising rent, adding a couple of fees, or maybe some premiums in there, that means you're almost doubling your income and lowering your expenses. So your income's already going up, which is awesome. Next, you have your value add potential. Like I said, or when I gave that example earlier about the value add property, this is where pretty much I've already summed it up, but can you increase rent with upgrades? So let's say you have an apartment renting out at $1,000 a month. Let's say it was built in 1990 and it hasn't been renovated since. But once you add everything new, you add all the efficient appliances in there. Once you get new paint, new carpet, new flooring, new everything pretty much, as long as it's in the budget and business plan, you can increase that rent to $1,500 or more because it's a brand new unit and you have all the fresh and new amenities in there as well. Maybe you even have included Wi-Fi for free. I don't know, but always depends on the business plan. You can always bring up rents when there's value add. Some properties don't have any value add, but the rents are below the market standard. So let's say the market average is $1,500 and you're looking at a property that's $1,300. That's $200 a month that you can increase across all units, depending on the size of the property, for rental income, which is your cash flow like we just talked about in the previous slide. So it's a really cool thing. Next, you have your financing strategy, which is conventional loans, commercial loans, or creative financing. I know Pace Morby does creative financing. I'm not an expert on it. In fact, I'm just starting to learn it because I know this is going to be a really good tool on my tool belt when I'm looking at properties and purchasing properties. But you can get these types of loans, for example, conventional or commercial, depending on the property that you have or depending on the lender that you're talking to. So it all depends on the business plan. I'm not too certain on the financing strategy. I would definitely recommend you do your homework. But all I know is that you can get a loan, you can work with lenders, and you can work with mortgage brokers and work something out in the business plan to get this property up and running and under contract. And lastly, you have investor relations, which is bringing in investors or equity partners to help with the financing. So a bank won't finance, they won't finance a property in full. You're going to have to make up for the rest of those expenses. So you can bring in investors, like, for example, depending on how much you need to raise, you can have a $25,000 to $50,000 commitment of investment, or if people want to invest more, by all means. But you want to make sure that when you're bringing in investors or equity partners, you want to make sure they're in their legal rights. Like, for example, 506C, 506B, are they accredited investors or are they non-accredited? I'll dig into that later in a video because that's a really technical topic. A lot of people are scared of 506B, 506C, and the SEC when they really shouldn't be. So I'll talk about this too because there's a lot of good stuff, but also legal stuff that goes into investor relations for raising capital or bringing capital in and getting the deal financed and getting investors in, and making your investors happy. So let's move on. So how do you even get started? I mean, like, where do you even begin? Where do you turn? But let's talk about it. So educate yourself, learn about market cycles, financing, and deal analysis. Best tool that you can use is YouTube. Like, just search anything related to real estate and it'll come up. Some that I do recommend is Rod Khleif with Lifetime Cash Flow, Neil Bauer with Grow Capitus and Multifamily University. What's also another good one? You could also use the Multifamily Mindset, which is with Tyler Devereaux as well. Who else? Dave Lindahl, who wrote Real Estate Market Trends and Multifamily Millions. He's also the owner of RE Mentor. So those are just a couple of people that I would definitely recommend you go and listen to on YouTube or listen to their podcasts and get some education from them. Because once you start looking deeper, you'll just start to find different articles. You can find different YouTube channels, different operators. You might even find somebody that's local, which is even better. So educate yourself, look at articles about market cycles, read and watch videos on financing and deal analysis, and just start educating yourself. Get yourself in the lingo, maybe go to a meetup or two and just hit it off from there. Next is build a network. Connect with brokers, lenders, and investors, other operators as well. Basically anybody that's in the real estate industry. Everybody has some knowledge and value to give. Everybody does. You could definitely connect with brokers, lenders, and investors. I would not recommend you do it right off the bat. You want to understand how to talk to these people correctly. You want to know what questions you want to ask, and you want to be at least well educated into the business before you start doing this. So you feel confident and you feel sure of what you're talking about, and you're basically, I guess, a now sophisticated investor. So it will be much easier to talk to these people and to ask questions and to understand what they're saying back. Because if you just start calling them right off the bat and they start using terms that you don't understand, you're going to hit a roadblock, and crossing that roadblock is going to be extremely difficult. So if you can prevent it in the beginning, in the long run, this will be really, really easy to do once you have all of this done and you've connected with other operators, investors, or real estate professionals in the field through online networking, maybe some groups, or in-person networking. Next is secure financing, which is understand your loan options and raise capital if needed. So that's like where I talked about, understand what kind of options you have. Is it conventional, commercial? Do you have bridge loan? How could this loan fit in the business plan or the property specifically? And understand how much capital you might need to raise, or who do you think is interested in investing? So before you start raising capital, I would highly recommend you understand the financials, understand how important the numbers are. For example, the underwriting, the T12, rent roll, so on and so forth. And then just educating yourself so you can raise capital, bring in investment partners properly, and to cultivate these relationships and leads so that you can keep your business fueled and still going up. Next, analyze deals. Use cash flow and cap rate formulas. So I'll go into these different metrics later on, but cash flow and cap rates is very important. Cap rate is basically how much you would, if I understand correctly, how much you would get back in return if you were to pay the property with cash. So when you have a higher cap rate, that means the price is lower. When you have a lower cap rate or compressed, that means the price is higher. But these numbers will fluctuate depending on like risk. So if it's like a really high number, then there's going to be risk involved. If it's a lower number, there's going to be less risk. But it all depends on the financial and technical aspect of the property in the business plan, or what you're looking for specifically. So always be analyzing deals. Maybe shoot a call over to a broker and say hey, I'm interested in looking at this property. Can you send me over the financials so I can look at it, look at the numbers, and just practice. Look at deals, go on webinars that talk about deals, some practice deals, and just talk with underwriting professionals so you can understand how to analyze deals. And just repetitive deal analysis will also help you with your lingo and education as well. And then lastly, take action, start small and scale up over time. I know a lot of people like to go big, but if you want to start small, just by educating yourself, building relationships, building partners, building systems before you even think about getting a property, this will help you scale over time. It's always about the relationships and systems way before the transactions, because those relationships and systems will get you transactions and will make sure those transactions follow through. And lastly, the summary and overview. Multifamily real estate is one of the best paths to financial freedom. Depending on your goals and depending what you're looking for, that may fit you, but it may not be so. Whether you are looking for cash flow, wealth building, or scalable investment strategy, this asset class provides long-term stability. And the key, take action, stay consistent, and build your portfolio over time. You don't build your portfolio instantly. This is a long-term process. This is not a get-rich-quick scheme. This is something you build over time. It's kind of like a car. You don't build one instantly. You do it one piece at a time. You understand what you're doing and you're hands-on, and just over time, you build something great. So anyways, I hope this quick introduction / rundown of multifamily real estate was helpful. If you're ever interested in just getting into real estate, send me a message. Maybe I can help you out. Maybe we can educate each other, learn and grow together, and maybe we got some opportunities together. But anyways, this is it. This is multifamily real estate in a nutshell. Thank you so much for watching, everyone. I hope you got some great value today, and I hope this helped you kind of open up your eyes of what multifamily real estate is and what I do when I'm not making videos. So anyways, take care, everyone. Have an awesome day, and I'll see you later.